Hello, I'm Chris Januszewski, and welcome to the Rebellious Times Podcast. Today, we've got an edition of the Supply Chain series, and I'm delighted to introduce you to Shane Walton, founder of Commercial Loan Brokers Institute. How are you doing, Shane?
I'm doing wonderfully. It's great to be chatting with you, Chris.
I appreciate your time. Where are you dialing in from today?
I'm over on the East Coast. I'm in the St. Augustine area in Florida.
Fantastic, but it's nice over there, like it is in Austin right now. We're not getting any of that snow that the rest of the country is getting.
We're avoiding that silliness.
Right, so I'm excited to talk money, finance. Love to hear kind of how you got started and your journey to where you are now with the Commercial Loan Brokers Institute.
Yeah. I started off in politics, and I largely feel like I never really left it. I just sort of changed the arena. Back in the day, I served as a Fulbright Fellow for the U.S. State Department. I was a university professor teaching political science after that. And then I got more hands-on running national legislative campaigns. And after that, I moved into private consulting, started a marketing agency that's now been running for over 15 years. And throughout all of that, what was really consistent was that I was always working in the field of persuasion, right? The mechanics don't change that much, whether you're persuading voters or you're persuading customers. You still have to go ahead and capture their attention. You have to earn trust. You have to frame the decision in the right way so they take the right action that you intend. And throughout this journey, I also saw that, I guess, in addition to persuasion, capital was another constant that I was always dealing with, right? It was always there, part of the same mechanics. And it was a central input that either slowed or accelerated the success across all the different domains that I was working in. And so I, from there, transitioned into spending most of my time now in the commercial capital world.
Love it. So I want to do a sneaky transition here. What you've mentioned there about your being a professor and understanding the politics and I believe the narratives, right, and how these are constructed. So we're in a world where sometimes it's almost difficult to believe what we hear from our politicians. One side said one thing, one side says the other. Rarely they come through with what they say, what they say they're going to do. And it's almost like a pantomime. It's almost like theater to say a few things to convince us to think certain things while they get to a certain point, and then they move on to the next thing, and we're left scratching our heads. And we're not able to go over to whoever the president is and say, "Hey, you said that and you didn't do it." There's nobody that will do that. How should the average voter be thinking about what we're hearing in terms of politics and how to manage our expectations? It's probably a tough question, this, but keeps the podcast interesting.
Always want to keep it interesting. So, a key part of my background is in political philosophy. I'm very much a systems-based thinker. So, for me, it really goes back to the mechanics of how politics occurs, right? If you think of the individual parties that are playing in this game of national politics or at a state or local level, right? Everybody has their own set of incentives. The voters have the incentive to get someone who's going to make their lives better, who's going to make the decisions that they want, that they believe are going to improve their lives. And the politicians have the goal of getting into power, getting elected into that role. And then you have the other non-voting players in the game, your corporations, your funders, your donors that have a similar interest in getting the right folks elected in order to go ahead and create the future that they want to see. And it's good that we have a system that has all of these different parties coming together. And it's designed to align and average out the outcomes for the better good of the majority, right? That's the purpose and the philosophy and the hope and the dream behind democracy. And then when you get into the weeds, those incentives get mixed up with the practicalities of life, right? It would be perfect if every voter really dug deep into the history of everyone on the ballot, right? At the state level, at the city level, at the national level. But how many people do you know, Chris, that really took the time to spend 1, 2, 3 hours researching each of the 20 candidates that they could vote for in the last election?
We don't have the time.
We don't have the time. So we're making decisions with limited information. And that's fundamentally how we're all making decisions, right? Every decision in our life has a degree of uncertainty to it. But we're in this maximizing process wherein the voters are trying to maximize the best outcomes. How much influence do they really have compared to how much time would it really take to do the research compared to, getting back to your question, what would come if they were to hold accountable the politicians for their initial promises. And you have a similar set of mechanics underlying the politicians' decision making, right? They have many different parties that they need to keep happy in order to continue their job. Not only do they have to keep their voters happy enough, they have to keep their funders and donors happy enough. And they also have to be able to work with the others in the same political game they're playing, because if you destroy alliances and you lose the favor of your party, again, are you going to be able to maintain your job and do what you want to do? So everybody has these competing desires, these competing goals. And I think the nature of democracy is a messy game because of this. But there isn't a clean game that we could design. The question becomes, for me, not necessarily is that voter doing the right thing? Should they have voted correctly or not? My camera just
That's all right.
decided
It
to
looks
go
good.
into
Your
its
camera's
Zoom again.
smarter than me.
So it's not about that one voter. It's not about that one politician, but it's rather about the nature of the system and thinking, could we improve our system? What levers could we tweak that would change the fundamental mechanics of the game? And I think that looking into the framework for campaign donations, the framework for how votes are placed and tallied, and how that limits or provides access to different American citizens. I think all of those sorts of things are fundamentally what are going to reshape our future and create a better averaged outcome of good for all than taking any one particular politician and saying you did this or you didn't do that or whatnot. It's really, in my mind, about how we as Americans construct the system. And then after that, the system will run and do what it does.
Yeah. Thank you. Thank you for sharing that. Obviously, you've got an expertise in that space and you can see what's happening. And hopefully, I think at this point, we need a brand new system, right? Maybe AI would do a better job than politicians until we can figure out a better system. But hopefully some entrepreneur maybe watching this podcast is capable of figuring this out. For now, thank you for that. Let's switch back to the subject, which is capital supply chain, how cash actually moves business. Tell me about your business and which customers you serve.
Yeah. So I have a number of different businesses. The one that you had introduced, the Commercial Loan Broker Institute, was really kind of the next logical step in everything that I have been doing in politics and branding and marketing. Finance showed up through my network and the business that I was doing. And I started working with a few guys who were they were planning what would become the Commercial Loan Broker Institute. And they had a deep a deep understanding of commercial finance from working in major banks for decades in the commercial lending space, but they needed someone who could take that knowledge and really turn it into a platform that other entrepreneurs could leverage, right? They needed the systems, the marketing, the branding, the tools, and most importantly, the educational framework that would allow someone to step into the finance industry and excel in not only creating a great company for themselves, but really in benefiting the economy as a whole. And all of that, education, creating tools, branding, systems, marketing, that was my lane from years of teaching, consulting, running branding and marketing campaigns. So I led the process of building out the Institute. And as I built it, I learned the capital side so deeply that it really has become most of my professional world these days. And I came to see that commercial lending is basically politics and persuasion, but translated into the language of numbers, right? The mechanics are the same. If you're persuading voters or customers or lenders, you're doing the same things. You're capturing the lender interest. You're earning their trust. You're framing their decision through your deal narrative and your package. You're persuading these two parties, the borrower and the lender, to agree on partnering to build something real. You're getting them to come across the aisle, as it were, and shake hands. One side is bringing the capital, the other is bringing the project execution. And your job in structuring the capital is to get them to believe in the same future and to invest, both parties investing in building that future together. So what I do now at the Institute and in our brokerages is really still the persuasion game, right? It's still politics. It's just a new arena. There's a lot more numbers involved in the language now, but it's still essentially the same sport I'm playing.
Brilliant. Thank you. Thank you for that. So on the supply chain episodes, often we're talking about moving physical products, right? Moving your inventory, moving parts for a building or machinery or whatever. But you can't move the physical capital to run the business. I'd love to kind of hear your perspective on why capital is important to making the whole kind of economy of the US run, and in the context that, businesses are hit with tariffs that are affecting a lot of supply chain, and of businesses having to rethink how they operate because of this. So capital factors into this. So yeah, I'd love to get your perspective on what capital means in this current economy for businesses.
Yeah. Well, let's play with that supply chain angle or frame and kind of start at the beginning, right? What is the supply chain? It's essentially the sequence of steps that turns an idea into a delivered product, right? Your raw materials show up, manufacturing happens, logistics moves it, distribution receives it, retail goes ahead and sells it, and it's this chain of dependencies all interlinked. And the supply chain really only moves as fast as its weakest link. If you don't have the raw materials, nothing else is going to start. If the equipment is down, production grinds to a halt. If shipping and warehousing isn't ready, finished goods just sit. That's why it's a chain, right? And strengthening one link in that chain makes the whole chain accelerate. But if you break one link, the whole chain stalls out. Now, with that understanding of a supply chain, most people think of capital as outside of that process, right? Capital that's numbers in a bank account. That's over there. It's the numbers on the P&L and the balance sheet. But when you think about it and how it actually functions in the real business world on a day-to-day basis, capital is one of the key inputs into the supply chain. In fact, you could argue it's the single most important input because it's in each step in that chain, and it is critical to whether that step will occur successfully and on time or not. Because capital is what buys the raw materials. It funds the trucks, the fuel, the labor, the equipment, the repairs, the inventory, the floor space. The motion of that entire chain is created by capital activating each step. So if the capital is missing, the chain doesn't just slow down, it just waits entirely until the cash shows up. And that's why timing is so important, because the right timing of capital is the difference between momentum and complete gridlock in the supply chain.
Thank you. Yeah, cash is king, as every early stage entrepreneur will learn pretty fast. Cash is king, cash flow is king. So, how has the lending market evolved, changed over the years, over the last, say, 10 years?
Yeah. So the lending market, fixing my
So
screen
you
there.
look
So
like
I'm
you've got
not
your own
seeing.
personal videographer that's constantly searching to find the best angle there. I love
I
it. I need to
know.
get one of
And I'm
those.
constantly fighting with it because it wants to zoom in and I keep trying to turn it off. But if I move my hands in the wrong way, it turns on autofocus and everything. So, and I talk with my hands too much. So the software and we need to have a conversation.
I love it.
But anyway, um, so you were talking about really what is the lending or what is the finance market looking like these days? Um, uh, when you look at kind of, if you zoom out, let's say, over the past decade, I'd say the biggest change in the lending market is that capital has fragmented and specialized. Right? 10 years ago, most business owners thought that financing meant going to a bank. But today, capital is more like a complex ecosystem. And for a long time, banks were the default. They were where you went for capital. And they're still a major player. They're the major player. But regulation, risk appetite, balance sheet constraints, all of these have pushed the capital demand into private credit more and more every single year. So you have non-bank lenders, specialty finance companies, your niche capital providers. And instead of one gatekeeper, one monolithic gatekeeper, you now have hundreds of gates. Each one has a different key that you need to use to get access to the cash behind it. And there's good news there, right? For folks, there's more options. There's more product types. There's a greater chance that any one individual company or real estate investor has a lender out in the market who's the perfect fit and wants to say yes to their project. But the trade-off is that the market is a whole lot less standardized. It's a whole lot more complex, and each of those individual capital sources has its own underwriting lens. One lender cares a whole lot more about cash flow and debt service coverage. Another one cares about collateral, another one about contract stability, another one, well, what's your exit strategy? And because of this, the question of, can I get a loan, Mr. Banker, has now turned into, how can I match my very unique situation to the correct, very unique capital source and present my story correctly so that they will see I am their perfect candidate?
On that note, sorry to interrupt. Do stories still factor in? So I remember when I was, a young lad, and my mum or my dad, they used to renovate houses. They had small businesses, and so now and again they'd say, "Oh, I'm off to see our bank manager," and they knew his name, and maybe take him out for lunch because he was going to make some of the decisions based on obviously principles of the bank, but he had some sway as to whether or not the decision was made. So obviously they would go and give a narrative. We're back on narratives again, and that would form part of his decision making. But we're in a world now where we've got technology that can do that, where you can talk into. You don't even have to write it, and it can understand the context of your business, and it can also understand the context of lending, and maybe come back with a solution. So, are we still in a world where your story your story matters, or is it now just about databases?
Oh, 100%. Story still matters. And at our institute, we're always training brokers to focus on the deal narrative, the story of what's happening behind that project. You have to be quick and succinct in today's world, but you have to, really show that what your project is, the story behind it, aligns with that unique lender's desires, their appetites, right? So story, you could argue, is becoming even more significant. It's just that everyone is interested in their own specific story. And so if you're telling a great story to the wrong lender who doesn't want to hear that story, well, it doesn't make a difference how good your story is. It's a question of alignment and fit. And you were talking about technology. Technology is another major shift that's accelerating all of this, right? Underwriting has gotten fundamentally more tech-enabled, more data-driven, and there's AI tools, such as you mentioned, and automation that can compress timelines dramatically. But that speed cuts both ways. You get an answer quickly, but you also get screened out quickly. And that screening can happen before a human ever gets to hear that story, before they ever understand where you're coming from or what it is that you're accomplishing or why you would be a good fit. So when you combine this diversification in lenders and you get more restrictive credit boxes that are due to the lender specialization. You add on to that the more rapid deal assessment with less human oversight. This means that in order to access capital today, your application needs to be much more targeted than it did 10 years ago. You have to be better at identifying who you should speak to, and you have to be better at telling the story in the way that they're going to care about. You're going into their listening.
Got it. Thank you. Thank you. One thing in the startup space that we've seen fairly recently is that, for 10, 12 years, SaaS businesses, with a good engineering and product team could quite easily pull money from VCs. VCs were desperate to, invest in 10 businesses knowing one will work out, and there was a lot of capital available. And now that's changed in that AI has disrupted the space and made it much easier to replicate software and software solutions. And so VCs, are typically, many are really looking for deep tech now to invest in. That's at least what I'm seeing. Are there any parallels to the lending, the brokerage industry that you're seeing? Whereas are there vertical industries where they're seen as more favorable right now, others where maybe capital's pulling away, or has it pretty much stayed the same?
So again, if we go back to the concept that capital used to be a bank conversation, and now it's an ecosystem, you see that there are lenders, just like VC players, who are interested in each and every different niche, each and every different industry. Why? Because they're looking for a competitive advantage. Right? That's the name of the game. They're looking for, how can I find the place where I can be better at underwriting, where I can be better at where I can have an edge, where I adjust my risk margins such that I can offer more favorable rates, such that I am offering a better product, i.e. cash, and with better rates or terms for some people, and I can get the right borrowers at the right risk level. So as we move from a bank conversation to an ecosystem, you're not seeing that there's one industry that is the one and only one that can get funded, right? It's just like in a natural ecosystem, there's the insects that thrive in this region and the insects that thrive over here, and everybody gets their little niche, their little place where they get to live and to thrive. And it's the same for capital as well as I would argue for the VC world, that you have, a bunch of funds that go ahead and specialize in individual areas. And this is really a story of there being so many more doors behind which there's capital, but at the same time, there's so many more keys that you need to know which one yours can fit into, which really is the reason that the kind of capital broker model has exploded, right? If you've got so much more fragmentation, someone has to navigate that ecosystem. And that's why brokers have become so valuable in today's capital market, because as it gets more complex, businesses and real estate investors, they need a guide in how to navigate this complex playing field.
Thank you. Love it. So, as we're thinking about entrepreneurs and businesses that are looking to expand the business and um, look for capital to do that, they need to be thinking about the narrative, and they should be looking for specialist brokers that will understand their industry and to give them a better chance of resonating and oh, getting the keys to the lock. So, is that a fair comment? And are there any other is there any other guidance you would give to small businesses or entrepreneurs looking for funding right now?
Yeah. So, yes. And when I'm talking about the fragmentation, I'm really talking about the fragmentation of lenders in each of their specialization, which is why there is such the need for the brokers, because the brokers can be working across a number of different industries, but they understand the lending playing field so that they have relationships with 20, 30, 40 lenders that love logistics and trucking firms. So that portion of the supply chain they can easily serve, and they know which lender is going to like which type of trucking company and whatnot. And then they have other lenders that focus on PO and contract financing for international trade. So if you are a manufacturing firm that has that international offshores production where you're importing, great. That's what they do day in and day out. That specific lender, or those 5 lenders in that broker's network, they play there. And so the broker is going to help you construct that narrative. They're going to help you package your deal in the right way so that the docs are saying the right things and telling the right story in the language of numbers, so that they already have the relationships. So they're positioned well to do that persuasion we started off talking about. The broker is positioned to capture the lender's interest because they already have the relationship. They already have earned the trust because they've done a number of deals together, and the lender knows this broker is going to deliver well. They then tell the story, they frame the decision for that lender according to that lender's credit box, what that lender is looking for from an underwriting perspective. And that's what they're showing the lender. And then they're also mitigating risks. Right? A broker is fundamentally a risk engineer, you could argue. They're saying, hey, they're not trying to hide a risk. When there's hair on a deal, when there's something that's negative about financing a particular project or whatnot, the broker is going to call it out because that's their job. But at the same time, they're going to clearly say, this is how we are mitigating it. Because of this, we're adding in additional collateral, or because of this, we're willing to accept more aggressive prepayment terms, or whatever it might be. So the challenges for the business owner and for the real estate investor are what have led to the loan broker industry, or the capital consultant industry, or whatever terms you want to use. And it's a natural reaction to the market and the challenges that business owners face. And it's a path forward for business owners that have gotten tired of getting a no from their bank to find a specialist who can help them get to that yes by understanding the playing field and leveraging the right relationships.
Got it. Thank you. Thanks very much. The value of partnering with the right broker there. So I've really enjoyed recording with you on our episode today. And maybe as a final thought, obviously businesses they borrow capital, they put a strategy together. Hopefully things are going to go great. They'll continue to grow, make money, hire. Everybody's doing fine. But many scenarios that doesn't work out. What happens when businesses don't deliver, and how can business owners kind of mitigate and prepare for the scenario where maybe things don't work out as planned?
Help me understand that question better, Chris. When you're asking how business owners prepare for when businesses don't develop,
Yeah.
or
So
don't deliver?
if I put a case together and I've got a business and I think I've got a unique value prop and I think I've got a path to grow and I need capital to do it, right? And with the capital comes certain conditions. I have to pay the capital back. I have interest rates. Maybe I have to put up collateral, right? Maybe the collateral is my house that my family live in. There are scenarios which can come up where, failure can have a massive impact on the entrepreneur, on the business, on the employees. How should entrepreneurs think about this? Should they just go all in? Are there certain special considerations they should give to protect themselves? How do we think about this?
No. So being an entrepreneur is a risky game. Entrepreneurs are not risk adverse by default, right? In order to succeed, you have to be willing to take on the challenges, the headaches, the heartaches that come with starting a business or running a big project or doing a new construction development. And that's not to say that they should by any means run in with a bag over their head, going full force and not worrying about what might be in front of them. No, you want to go ahead and to plan practically. You want to mitigate risks to the most practical degree that you can. But I don't think there is an ability in the game of entrepreneurship to actually eliminate all risks and to guarantee that your new startup is going to be a huge success like you hope. So this becomes a question of how do you both position yourself for future success and mitigate risks simultaneously. And it's not going to be a guarantee of future success. And it's not going to be full elimination of risks. It's just going to be a process of optimization for both. And this comes down largely to the financing vehicles that you select, right? Because each vehicle and each lender and literally each loan contract is going to have its own terms that dictate the risks for all parties. Right? Lenders and borrowers are coming together and they're fundamentally sharing risk together. They're both shouldering risk. A lender lends out money, they're not guaranteed it's going to come back. A borrower borrows money and they're not guaranteed it's going to be a profitable investment, and they might end up in a bad situation because of it. What we do is focus on alignment between the capital structure and the value in the business, and selecting the capital structures that align with that business and their cash flow can significantly decrease risk. We started off talking about the supply chain, right? And within the supply chain, we were discussing how timing of capital is so significant, right? Because if let's say we'll take a manufacturer and they land a big purchase order, and on paper, that's great news. But in reality, it becomes a stress test for that business, because now they have to buy materials and they have to pay labor before the customer ever pays them. And so if you don't have that cash on hand, you can't front it, then you can't fulfill the order and you can't grow, right? But if a lender underwrites against that contract using that purchase order or receivables, then the capital is going to show up at the front of the supply chain. And that unlocks the production, the payroll, the delivery, the revenue. With that, your lender is, for PO financing, underwriting based on the purchase order, right? So you might be able to get a scenario where, depending on the purchase order, you have low recourse or non-recourse financing, or accounts receivable financing, which is invoicing after the fact, very common. So we think through our supply chain. That was a manufacturer example, but think about a trucking company in the supply chain. They go to that manufacturer's facility, they pick up the load, and they take it across the country to the warehousing. And along the way, they pay for the truck, the fuel, the driver, the repairs. And then they deliver that load and they wait 30 days to get paid. In the meantime, they've picked up another load, driven it back across the country, and that gets really expensive, and that's hard on the company. But it's not that they're not going to be profitable. It's a timing gap on when the capital ends up at that segment of the supply chain. So if they factor those invoices or receivables, the cash arrives immediately after delivery. One of the brokerages that we launched through our institute then moved into becoming a direct lender. So now they do the lending, and they do it just for logistics companies. Rubber Duck Funding. Old movie, Rubber Ducky, trucking movie. Look it up. It makes more sense than it sounds. So anyway, Rubber Duck Funding, they do this financing just for trucking companies. And it's transformative because it allows that trucking company to take the next job without starving their financial engine. And that stabilizes the whole supply chain. But going back to your question of risk, what they're doing is they're selling their receivables. And if they sell it without recourse and the customer doesn't pay them for their services of shipment, there's no recourse, there's no bad outcome for the trucking company that got the funds, right? It's the lender taking that on. And you can choose different types of financing that will limit your exposure, that will limit your risk. It's not to say every entrepreneur can choose non-recourse financing, because that's not the world we live in. It is to say that working with a specialist positions you to leverage all the different options you have in the playing field, and in so doing, by selecting the right capital structure, to significantly decrease the risk that you have. Same is true in commercial real estate, right? It's all about the capital stack. You've got your piece, the equity you're putting into a new project, and then you've got your senior debt that is going to be the majority of it. And then you've got maybe you could have different levels of equity in that stack, but maybe you have a mezzanine lender in there. But each one's taking on a different level of risk. And by structuring the capital stack in the right way, the project sponsors, the borrower's risk gets minimized, and could be as little as just, hey, if this all goes to hell in a handbasket, you're going to be out whatever you put into the project. And maybe you were doing a 20% equity investment, or maybe you as the project sponsor only put in 5%, and then you raised the other 15% from other equity. And then you got a 60% senior and you filled the gap with some mezzanine. It could be that you're limited to your 5% that you put in. Not say that doesn't hurt, but if you're, running a $100 million project and you have 5 million in, you could have won immensely and you only had to risk 5. It could be a very risk-adjusted positive place to be. So that's why the capital structure has such an impact on entrepreneurs that they often don't think of. They still think in the model, so many business owners that don't live and breathe this, think in the model of, I need cash, I go and get a loan, probably from my bank, when the real world is so much more complex with all
Well,
the financing tools we have available.
that's exactly what I was getting in here, and it might sound obvious to many people that have really spent the time to understand, business finance and how to manage the cash. But there are also entrepreneurs out there who are very good at whatever they do, have a very good product or a very good service. And they may look at the financing side of the business as kind of a boring part of the operations, right? And I'll get some money and see how it goes. And that's not the way to do it. You know, every business owner needs to really dig deep and get to that next level and kind of understand what capital means to them, um, monitor it, adjust accordingly, and kind of have a vision and a forecast moving forward.
Yes. Yes, indeed.
Brilliant. Shane, if somebody wants to contact you or check out one of your businesses, where should they go?
If you're looking to explore what it means to become a capital consultant and really enter the market and broker capital like we've been discussing today, check out commercialloanbrokerinstitute.com. And you can find all of our socials through our website. If you're looking for financing, check out alternativefundingpartners.com, where we provide all of these consulting services and structure capital for clients on a daily basis.
Wonderful. Thank you so much. I really appreciate your time, Shane, and I look forward to speaking to you soon.
Thanks. I enjoyed our conversation. Take care, Chris.
Cheers.